Let's start with the big picture. Throughout history, people have turned to real, scarce assets to preserve wealth during times of uncertainty. Gold has always played this role, but silver, because of its dual use as both money and an industrial metal, has a unique place in the system. Now, here's the principle I want you to keep in mind. If you want to understand how much silver you need to be in the top 1% of stackers, you have to look at the distributions, not the averages. Most people think about averages when they think about wealth, investing, or accumulation of assets. They ask, how much does the average person own? How much should I own to match or beat that? But the world does not really operate on averages. It operates on distributions. The difference between the two is critical to understand, and it's especially important when thinking about silver ownership and what it means to be among the top 1% of stackers. If you only focus on averages, you will get a distorted view of reality. The average can be misleading because it blends together people who own nothing with those who own a great deal, and the result is a number that does not really represent either group. It gives the illusion of a middle ground that most people don't actually occupy. Distributions tell you who owns what, how ownership is spread, and where the cutoffs lie between the top, the middle, and the bottom. If you took all the investable silver in the world and divided it equally across the global population, the average holding per person would appear small, maybe just a few ounces. But that's not how the system works. In reality, most people own zero silver, and then a small minority owns a meaningful amount. So when you try to figure out how much silver puts you in the top 1%, you're not comparing yourself against the average person. You're comparing yourself against the few who are actually in the game. The difference is dramatic. You don't need to own billions of dollars in silver to be in the top 1%. You need enough to put you above the vast majority who own nothing or next to nothing. That amount is far lower than most people imagine, yet it makes all the difference in terms of positioning. This is the same principle that applies in wealth distributions generally. In almost every society, wealth follows what's called a power law distribution. A small number of people own the majority, while the rest own very little. That pattern repeats itself in asset classes like silver. The 1% of stackers hold disproportionately large quantities compared to the rest. So the lesson here is to stop anchoring on averages and start thinking about where you fall on the distribution. Do you want to be in the bottom 90% with virtually no exposure, in the middle with a little but not enough to matter, or in the top 1% where you actually have meaningful positioning? This way of thinking changes your strategy. If you chase averages, you might be satisfied with a handful of ounces and think you are covered. But if you think in terms of distribution, you realize that's not enough to distinguish you from the crowd. You need to be ahead of the curve to benefit from the dynamics that play out when scarcity and cycles collide. Silver is a small market relative to stocks or bonds, so when shifts happen, the effects are magnified. Being above average isn't sufficient. Being meaningfully placed within the distribution is what matters. That's how you get asymmetric outcomes, where small moves in your position can translate into large advantages compared to the majority. So when you hear people talk about how much silver you need to be in the top 1%, remember that the key insight is not the number itself, but the principle it represents. You don't need to benchmark against averages, you need to benchmark against distributions. That's how the real world functions, and that's how you build resilience. It's not about being average, it's about being positioned correctly when the system shifts. Understanding that distinction is the foundation of strategic thinking in markets, and silver is a perfect example of why distributions matter more than averages. When people think about being in the top 1% of any asset class, they usually imagine you need a fortune. To be in the top 1% of stockholders, you need millions, often tens of millions. For bondholders, you may need even more. These thresholds are so high that most people never even consider them within reach, but silver is different. The barrier to entry is surprisingly low, and that fact carries big implications. Unlike other financial markets that are dominated by institutional players, silver is a market where ordinary individuals can realistically position themselves among the very top participants with a relatively modest allocation. That is what makes it unique and what creates the asymmetry of opportunity that few people recognize. To understand why the barrier to entry is low, consider the size of the market. The silver market is small compared to the stock market or even the gold market. The amount of investable silver available to individuals is only a fraction of the overall supply, because so much of it goes into industrial use. Out of what is left for investors, the holdings are spread unevenly, with the vast majority of people holding none at all. This creates a situation where, if you own even a few hundred ounces, you are already well above the median. If you accumulate a few thousand ounces, you may find yourself in the top tier of holders globally. By comparison, to reach an equivalent percentile in equities or real estate, the numbers are many orders of magnitude higher. That gap between perception and reality is what creates opportunity. It's important to understand that the low barrier doesn't mean the opportunity is trivial. In fact, it means the opposite. When an asset has a low barrier to entry and a small pool of committed participants, it only takes a minor shift in sentiment or demand to produce outsized moves in price and positioning. If suddenly more people decide they want to hold meaningful amounts of silver, the distribution changes quickly, and the early movers benefit the most. Being in the top 1% is not just about prestige. It's about leverage in thin markets. You don't need to be a billionaire to gain that leverage. You only need to recognize that the door is open for anyone who takes the time and discipline to step through. Another important point is psychological. People often overestimate the difficulty of achieving top-tier status in an area where they've been conditioned to think only the wealthy dominate. That mindset holds them back. They assume the 1% is out of reach, so they never try. But in the case of silver, the numbers tell a different story. The barrier is not millions of dollars. It's often the price of a modest vehicle or a year's worth of savings. When you reframe it this way, suddenly the notion of being in the top 1% feels attainable. That shift in perspective is crucial. It shows you that this isn't about competing with billionaires. It's about recognizing an underappreciated asset class where the distribution curve is still in your favor. This doesn't mean everyone should pour everything into silver. Balance is still a principle that matters. But it does mean that if you want to hold an asset where you can genuinely be among the top participants without enormous cost, silver is one of the few opportunities that offers that. And when cycles turn, when trust in paper money declines, or when industrial demand tightens supplies, those who made it into the top percent will have positioned themselves not just for protection, but for outsized advantage. The barrier to entry is low, but the rewards for those who step across it can be disproportionately high. When you look at silver as a market, one of the first things you notice is that it is relatively small compared to other asset classes. The total value of all investable silver is tiny next to global equities, bonds, or even gold. This small size is what makes silver a thin market. Thin markets are characterized by fewer participants, lower liquidity, and wider price swings when demand or supply shifts. That thinness is both a vulnerability and an opportunity. It means that when demand rises even slightly, prices can move with disproportionate speed and magnitude. Conversely, when sellers flood in, the market can fall sharply. Understanding this nature of thin markets is critical to grasping why silver behaves the way it does and why being positioned before these moves occur can make all the difference. Imagine a vast ocean like the bond market, where billions of dollars move daily without much impact on price. Now imagine a small pond like the silver market, where even a single large stone causes big ripples. Silver's market is the pond, because most people do not own any silver, and because industrial consumption locks away much of the annual supply, the portion available to investors is limited. When new demand arises, whether from individual stackers, institutions reallocating a fraction of their portfolios, or industrial users facing shortages, the effect is amplified. A small percentage change in demand can translate into massive price swings, simply because the market is too thin to absorb the shock smoothly. This is why history shows that silver moves explosively during periods of stress or monetary transition. The 1970s are a prime example, when inflation eroded confidence in fiat money and silver prices multiplied within a few short years. More recently, in 2011, a wave of investor interest pushed silver near $50 an ounce before retreating. These moves weren't the result of massive global reallocation like you'd see in the stock or bond markets. They were the outcome of relatively small capital flows that overwhelmed a thin market. That's what makes silver both volatile and powerful. Thin markets do not move gradually. They leap, and those leaps create opportunities for those positioned early. From an investment principle perspective, thin markets reward foresight and punish hesitation. If you wait until the world is already rushing in, you will likely be buying at or near the peak of a surge, when liquidity dries up and premiums rise. If you establish your position beforehand, you benefit from the disproportionate upside when the crowd finally turns its attention. That is why understanding silver's thinness is not just an academic observation. It's a practical guide for strategy. You cannot treat silver like you would a massive, liquid market where entries and exits are smooth and predictable. You have to respect its structure and position accordingly. It's also worth noting that thin markets like silver are prone to manipulation because it doesn't take as much capital to influence prices. This is why paper contracts on exchanges often create artificial volatility, and why stackers emphasize holding physical metal. The thinness of the market makes both the risks and the potential rewards greater. That is part of what draws in disciplined contrarians, those who understand that volatility is not necessarily danger, but sometimes a sign of opportunity. Ultimately, the key insight is that silver's thin market structure means it does not take much to trigger big moves. That reality shapes both the risks and the rewards. If you understand it and accept it, you can use it to your advantage. If you ignore it, you may be caught unprepared when the inevitable volatility arrives. In thin markets, being early and being steady are the principles that matter most. Silver, as one of the thinnest meaningful global markets, exemplifies that truth. Every system in economics, finance, and even society runs in cycles. You see it in credit, where borrowing expands, peaks, and contracts. You see it in business activity, where periods of growth are followed by slowdowns. You see it in currencies, where confidence builds, erodes, and eventually resets. Silver, like all real assets, is deeply tied to these cycles, And understanding where we are in the cycle is the key to understanding why silver matters today. If you look at history over the long term, fiat currencies always lose value over time because governments print more money than they can back with real assets. The long-term debt cycle, which Ray Dalio often emphasizes, is a pattern where rising debts eventually outgrow the ability to be serviced, forcing central banks to lower interest rates, create more money, and devalue currency. That process usually ends in a restructuring or a reset. We are late in that cycle now. Global debt is at record levels. Central banks have been running loose monetary policies for more than a decade, and every time stress appears in the system, the answer has been more money creation. That keeps the game going, but it comes at the cost of eroding the value of paper money. When confidence in fiat currencies begins to erode, people instinctively look for alternatives that cannot be printed, inflated away, or easily manipulated. This is where silver enters the picture. It has been used for thousands of years as a store of value and a medium of exchange, and while it lost its formal role in the monetary system during the 20th century, its properties remain unchanged. It is finite, tangible, and universally recognized. Cycles tell us that every time trust in paper systems declines, there is a return to hard assets. In the 1970s, when inflation surged and the dollar was detached from gold, silver rose dramatically. In the aftermath of the financial crisis of 2008, when central banks printed trillions, silver again spiked as people sought protection. These moments were not random. They were part of the repeating pattern of debt, money, and confidence cycles. We are now entering a phase where those pressures are once again converging. High debts, high deficits, and declining trust in fiat money. If the cycle repeats, silver will again play its traditional role as a hedge. What makes silver especially powerful in these cycles is its dual nature. It is both a monetary metal and an industrial commodity. That means it responds not only to shifts in monetary confidence, but also to broader economic cycles tied to technology and industry. As green technologies expand solar panels, batteries, electronics, the industrial demand for silver rises, even if monetary demand is quiet. When both monetary and industrial demand converge, the cycle accelerates. Historically, these convergences have created explosive price moves. Understanding cycles also teaches us another principle. Timing perfectly is impossible, but positioning matters. No one can predict the exact year or month when trust will crack or when monetary systems will reset. But we know the cycle is inevitable. Every empire, every currency system, every debt-driven boom follows the same arc. The winners are those who recognize the stage of the cycle early and prepare, not those who try to guess the precise moment of the turn. Silver is one of the few assets that has consistently provided that protection during the late stages of debt and currency cycles. So, the real lesson is not to think of silver as a trade, but as part of a broader strategy of cycle awareness. If you accept that cycles drive everything, then you also accept that we are approaching the late stage of the current one. That recognition leads naturally to holding silver, not as speculation, but as preparation. The cycle will turn, and when it does, those who ignored it will be caught by surprise, while those who respected it will find themselves holding an asset that history repeatedly proves to be essential. When people talk about silver stacking, the conversation almost always drifts toward numbers. How many ounces should you own? What amount puts you in the top 10%, the top 1%, or even beyond? It's natural to want a clear number to aim for, but if you think like Ray Dalio, you know that numbers alone aren't the real answer. What matters more than the exact ounce count is the principle behind owning silver and the role it plays in your overall portfolio and strategy. Principles guide you when circumstances change. Numbers only anchor you to a specific point in time. The principle here is resilience. Silver, like other hard assets, is not about chasing a magic figure. It's about ensuring that you hold enough to be meaningfully protected against monetary shifts, inflation, or crises in confidence. If you tell yourself that 500 ounces is the right number, you may feel safe when you reach it, but safety doesn't come from a static number. It comes from being balanced relative to the risks in the system. In one environment, 500 ounces may be more than enough to put you in a strong position. In another environment, where fiat money is devalued rapidly, it may not be enough. The principle that endures through both situations is that you want to hold silver in proportion to the risks you face, not in proportion to a number someone else has defined. Another principle is asymmetry. Because silver is such a small market, relatively modest allocations can put you in the top percentiles of holders. That asymmetry means you don't need to overextend yourself. You don't have to choose between silver and everything else. You can hold enough silver to be resilient without sacrificing diversification. The number matters less than the idea that small positions, if held consistently and with discipline, can carry outsized benefits when cycles shift. This principle helps you avoid the trap of thinking you need to go all in, or that you're behind because you haven't reached an arbitrary ounce milestone. There is also the principle of cycles. Markets, currencies, and economies operate in repeating patterns. We know fiat systems eventually devalue. We know that trust erodes in waves. The principle, therefore, is not about timing silver perfectly or reaching some magic count before the big move happens. The principle is simply to be holding it before the cycle turns. The actual number of ounces may differ from person to person depending on means and goals, but the underlying principle is universal. Be prepared before the storm, not during it. Focusing on principles over numbers also frees you from comparison. It's easy to look at forums, videos, or other stackers and feel you don't measure up because someone else has 10 times the ounces you do. But comparison is misleading because everyone's circumstances are different. What's a small allocation for one person might be a significant allocation for another. The principle is to build your position relative to your own resources and risks, not relative to someone else's stack. Anchoring to numbers creates anxiety. Anchoring to principles creates clarity. Finally, principles endure. Numbers change with inflation, with population, with market shifts. 1,000 ounces today may not mean the same thing 20 years from now. But the principles of resilience, asymmetry, balance, and cycle awareness remain just as valid. They guide your behavior no matter what the external numbers look like. That's why Dalio always emphasizes principles over details. Details are fleeting. Principles are the foundation. For silver, the principle is that you don't need to hit a magic number to succeed. You just need to hold enough consistently to protect yourself and to participate in the upside when the inevitable shifts in the system occur.